Good morning and welcome to our webinar today, which is all about protecting your family's future, where we're covering the topics of probate, wills, LPAs and inheritance tax. I'm delighted to be joined this morning by Peter McMahon, who's a partner at Grunberg Co. We're also joined by Sunil Ghela, who's a manager at the firm, and our guest speaker is Sloam from NSS Legal. So welcome to you all. We will have a Q&A session at the end of the presentation this morning. So if you're familiar with Zoom, you'll be familiar with the Q&A tool on the toolbar. If you just click on that, if you want to ask a question as we go along, please use that Q&A panel to post your question. We may answer some of them as we go along, but we'll try and cover all of them at the end of the presentation today, if we possibly can. So at this point, I will hand over to Peter and I will see you at the end for the Q&A. Over to you, Peter.
Thank you, Jo. Good morning, everybody, and thank you for joining us today. I'm just going to run through now a quick overview of what we're going to cover today. So I'm going to start off with the probate process, a quick run through of the rules there. Sunil is going to go through the rules of intestacy, so what happens if you die without a will in place. Oliver is then going to talk to you and explain making a will and also a lasting power of attorney. And then it's me again, and we'll go through some inheritance tax examples at the end. So, what is the probate process and when is it needed? Essentially, as most of you I'm sure have guessed, the probate process is what happens when somebody dies. It's about essentially collecting their assets, paying off any debts they owe, and then passing all the assets out to the family members who are named in the will, known as the beneficiaries. So the very first thing that you would need to do after you've registered the death of somebody who's died is you need to find the will. This is obviously very important. Sometimes you'll know where the will is. Sometimes it may be with a firm of accountants, firm of solicitors, but it's very important that you do actually find the last will and testament of the person, because this is the valid will. Any wills made before are invalid. Most people are familiar with that concept. Once you've got the will, you've effectively got the roadmap as to what to do with that person's assets, and then you need to get the executors on board. Some may choose not to go through with their executorship, and there are processes for that, but essentially the executors are responsible for carrying out the will of that person and collecting, as I say, all the assets, paying off the debts, and then passing those assets out to the beneficiaries. So, as you can probably imagine, there is a lot of contacting, a lot of writing. You've got to basically get in contact with everybody that you know that person who has had contact with or had assets with. Fortunately, the government a few years ago now introduced a service, the Tell Us Once service, which means that you are effectively a one-stop shop. You notify once, and thereafter many of the government institutions, the DVLA, HMRC, etc., will actually get notified from that one notification. So it's a very useful service, works very well. It's then, unfortunately, there isn't anything like that for all of the banks and building societies. You've got to go and then get in contact with them and write to them all, notify them about the death, and ask them for information. What information is that? So when someone's died, as I've said, you need to draw up it's effectively a balance sheet. So what that person owns and their values, less what they owe at their date of death. So it's very much contacting, as I say, all of these various parties, asking for the values at the date of death. Where you've got property, you may need to get a property valuation. We normally would certainly recommend that. And then also an important part is to complete an income tax return. So especially if that person normally does an income tax return, they may have income tax to pay, or they might be due a refund that actually has to go on the inheritance tax return. Once you've drawn up that balance sheet of that person, you then need to put all of those values on a notoriously detailed and complex form, an inheritance tax return. However, it's worth noting that there is, in certain circumstances where you've got an estate below £1 million and there's no complications, you can actually do a shorter IHT form if the estate is exempt, and it's a much simpler form to complete. It's the IHT 205. I would always suggest making sure that you've had it in advice, writing, that you can use the smaller form and you're comfortable doing that. It's then a case of paying the inheritance tax within 6 months of death. The inheritance tax return is actually due 12 months from the end of the month of death. And then once you have submitted the inheritance tax return and paid the inheritance tax, you can then go and apply for probate. Okay, now probate isn't always required. I'll go through what probate is in a second, but situations where you might not necessarily need a grant of probate is if you were dealing with a relatively small estate. Let's say you had a house only, husband and wife, maybe they had a couple £100 in the bank account, and they've got a property that they own, crucially, as joint tenants. If they own it as tenants in common, you will need to go to a conveyancing solicitor. You will need probate, because without probate, you will not be able to transfer that property out. So the probate process, I've mentioned before, is the end step. So you, once you have probate, it's essentially a piece of paper which is issued by the courts, which allows you to go and execute the will and get hold of those assets, because up to that point in time, you can't actually do anything with the assets. They're ultimately frozen. So how long does that process take? So from start to finish, we would normally suggest that with a simple estate, you're looking at a minimum period of 6 months. Much more complicated estates can take a lot longer than that. But one of the reasons we actually got into it is that we saw that probate seemed to take an unnecessarily long amount of time. And it's very rare for us to have a situation where one would go for over 2 years. It's quite an important process as well, and people tend to want to get the process done as quickly as possible, because for a lot of people, it's the last stage of mourning. It draws a line under the matter, and then they can move on with their lives. It's quite a complicated process, as I've said. So, as I said, once you've got the grant of probate, it's been issued and you've received it, you have this piece of paper, and you can now go and tell all those people that have not been allowing you to have the assets to go and say, please, can you do this for the assets? And you can then go and pass them out to those beneficiaries. Top tip, always ask for a number of copies of the grant of probate at this point in time, because the last thing you want to do is find you've got to write to 20 different people. They all want to see normally the official grant of probate. A photocopy won't do. So get it at this point in time. Otherwise, you have to go back. It's more costly and more cumbersome. So I suppose many people wonder perhaps, why did Grunberg Co enter into probate? Because it's notoriously a solicitor's field. I believe well over 10 years ago, our founding partner, David Grunberg, was on a call with a client. He called me over, so he had the client in his room. And I went to his room and he was shouting with somebody on the end of a phone. It was a solicitor. And they couldn't agree what should be going on the inheritance tax return. In the end, the call ended, the solicitor was sat by the client, and David asked me, did we know anybody that could help? My answer to that was something along the lines of, David, it's a tax return, I'm sure we can get that done. And yeah, so at that stage, that was the very early birth of Grunberg Co Probate Services. We were somewhat restricted in what we could do, and we were always very careful in the early days as to what we could do. But for a good number of years now, the ICAEW applied to the Law Society to be able to allow accountants to be authorised to undertake non-contentious probate matters. So fairly early on, as soon as this happened, we wanted to be able to offer the full range of probate services. We've been doing this for many years now as authorised probate service specialists. Again, just a minor point there, that if you have a contentious probate, so where somebody is perhaps challenging the will or something like that, you would not be able to do this under a normal probate service. You would need a specialist solicitor normally in that situation. A very costly one as well, I might add. Okay, so I'm now going to hand you over to Sunil, who is going to explain what happens if you do not have a will, something we all suggest that you should have, which I will cover in a moment. Sunil, I'll hand over to you.
Thank you, Peter. What happens if you don't make a will? Basically, the government has set out some special rules. And an individual passes away without a will, the government has provided rules as to how the estate is distributed, and they're called intestacy rules. To determine which rules apply, you have to look at the marital status of the deceased. When a single individual passes away, the estate goes to the surviving relatives. The order of distribution of the estate is decided on the closeness of relationships to the deceased, beginning with children and extending as far as half uncles and aunts. If there are no surviving relatives, everything goes to the crown. The deceased individual may have supported a charity in their lifetime, and they could have left the estate to the charity rather than estate receiving all the money. So if they had a will in place, this could have been avoided and the child could have benefited from it. If an individual who was married and in a civil partnership has a surviving spouse who has survived 28 days, then the estate, if it's less than £270,000, everything goes to the spouse. If the estate is more than £270,000 and there are no surviving children, then all assets go to the spouse. If the estate is going to a surviving spouse and children, the first £270,000 goes to the spouse. The remainder is split half between surviving spouse and children. The children split equally between the half share. The half share goes to the spouse, is exempt from inheritance tax, but the half share going to the children is subject to inheritance tax, which may mean selling a capital asset, for example, a family home, and to pay inheritance tax. Therefore, dying without a will has two consequences. First is the estate is not passed down to who you want it to benefit from, and having to pay additional inheritance tax. At Grunberg Co, we provide inheritance tax planning advice to ensure that the will as drawn is efficient, tax efficient. In my experience as probate manager, I've come across wills that have been tax inefficient and leading to a time-consuming and expensive route of getting a deed of variation prepared. When we have done inheritance tax planning, or when we've had to prepare a deed of variation, we have gone to Oliver to ensure the tax planning as we intended it to be. At this point, I hand you over to Oliver to talk to you about wills.
Thank you, Sunil and Peter, and thank you to Grunbergs for having me here this morning. So, why have a will? With your will, you, not the government, can choose who you wish to receive your assets and who you wish to be in charge of distributing your assets. If you have minor children and both parents don't survive, you can appoint a guardian to look after those children, hopefully preventing an argument in the family over that question, and you can decide how your beneficiaries receive assets. If your will was made a long time ago, your wishes and circumstances may have changed. For example, you may have had minor children who are grown up and are now suitable for the role of executors, or your children may be about to marry and you may wish to protect them in the event of any divorce through your will. If, since you made your last will, you've been married or divorced, your will could have been made invalidated or partially invalidated, And when making your will, you should receive good professional advice, hopefully from a solicitor, on the construction. We have dealt with the family of a client who had the intention of leaving everything to his partner and made a self-made will. He had listed his assets one by one, specifically referring to bank accounts, investments, and property. By the time he had died, he had actually inherited other assets from his family and had different bank accounts and investments. Now, because a partner isn't automatically treated as next of kin, those assets had to pass under the rules of intestacy, and they went to his cousins, some of which he didn't even know. If you made a will a long time ago, you may have beneficiaries or assets in other jurisdictions, and in certain circumstances, it may be more suitable to have a local will dealing with those assets. For example, it may be more suitable to have a local will dealing with a property like a holiday home abroad, and that can sit nicely alongside your UK will if constructed properly. Just to say, you should review your will regularly when your circumstances change, people born, people die, when global circumstances change, or at least every 5 years to check that they reflect your wishes. So, during COVID-19, most private client practitioners have seen a surge in people wishing to review their planning, their wills, and the provisions that they make. And you may be aware that there is a requirement to sign a will in the physical presence of 2 independent witnesses who must also sign the documents and complete their details. And that's obviously been a problem for people who are isolating or shielding or sick. The government are temporarily amending current legislation so that wills can be witnessed by video conference. And what they are doing is changing the law retrospectively, so it will apply from January 2020 until 31st of January 2022. And this is how it will work. The testator, the person making the will, needs to go online live to a video conference with his 2 witnesses. He will sign the document whilst they are watching, and they must be able to see the original document and the signing process. The testator, the person making the will, then needs to send or courier or deliver the physical hard document, the hard copy, the original document, to each of his witnesses, who must go back online with the other 2 parties, the other witness and the testator, and sign whilst the other 2 are watching. When all three parties have signed the document, it will be valid from the date the testator, the person making the will, first signed the document. Now, there are a number of potential pitfalls. Firstly, because there are 3 people who need to sign the document and it needs to be couriered or taken to them, there may be a delay in the signing process. If one of those parties die in the middle, there will be an issue. 2, there is an expiration date on the change to the law, so that any will signed using this method after January 2022 will be signed invalidly. And finally, because you need to send the witnesses the original hard copy document, they may read it, and that invades your privacy, and you may not wish for them to see it. We would recommend that this method is only used as a method literally of last resort when someone's very sick, and if possible, it should be signed in a traditional way, but using social distancing methods as necessary. Finally, a word about lasting power of attorney. Lasting power of attorneys are often forgotten in the planning process, and actually, whilst wills are about everyone else and who should receive your assets, lasting powers of attorney is about you and who looks after you in the event that you lose capacity and you can't make decisions for yourself. These are split into 2 documents, one for health and one for finances, and you can appoint the same attorneys in both, or you can have different ones depending on the suitability and your family dynamic. We are currently assisting a family. Their father has had a stroke, and the doctors have judged that he lacks capacity and is therefore incapable of making a lasting power of attorney. He requires nursing, care, medical attention to the tune of several £1000s, and his family are not able to automatically access his bank accounts to look after him on his behalf. They need to go through a lengthy process process, you apply.
Okay, I think we may have lost. Oh, Ollie, I think you just dropped
I'm
out
back.
there.
I don't know where I went out.
Okay.
I was saying that we are assisting a family whose father recently had a stroke, and he requires care, medical attention, and nursing to the tune of several £1,000s. And because his family can't automatically access his bank accounts on his behalf, they need to lay out the money where they can. They are faced with applying to the Court of Protection for the right to access his bank account to make decisions on his behalf, and this will take them 6 to 10 months. This could have been avoided had the father put in place a lasting power of attorney saying who he wished to step into his shoes in the event that he lost capacity. I'm going to hand back to Peter. Thank you.
Okay, thank you, Ollie. Just reassurance, we did check with everyone before we did this webinar that no one is using Virgin. So, right, I will move on to the next slide. Why would, will my family have to pay inheritance tax? So, it wouldn't be an accountant's webinar without some numbers. So, let's have a look at some now. I think most people are familiar with the nil rate band. It's been frozen now for many years, as long as I can remember. But essentially, every single person who has assets in the UK needs to pay inheritance tax. However, there is a nil rate band, so they are allowed to have assets less liabilities amounting to £325,000. They don't have to pay inheritance tax. They may still require probate, as I mentioned earlier, but there is no requirement for them to pay inheritance tax. Now, it is possible as well. Many years ago, we used to have to pay Ollie and Co fees in drawing up a special kind of will, so that when everything passed from one spouse to another, there's no charge, everything is exempt. But you would have in that situation lost one of the nil rate bands. So you would have to get a special clause in your will to create something known as a discretionary will trust, and that would be at the nil rate band. So all it would be effectively is an IOU, so that when the second person dies, they get 2 lots of 325. That we don't need that now because it's an automatic provision that's been around for many years, which the government introduced. And everybody who is crucially married or in a civil partnership will get 2 lots if they don't use anything on the first death. A lot of people may also be familiar with the term of the new resident nil rate band. So a few years ago, the government were under quite a bit of pressure to raise the inheritance tax threshold to £1 million because people felt it was very unfair that, let's say you have a family living in a home in a city where house prices can very easily exceed £1 million. They've got no other assets, and the parents pass away, the children are living there, they've got no money to pay the inheritance tax on that property. So there was pressure for the government to say, well, you're kicking people out of their homes, what can we do? Raise the nil rate band to £1 million for married couples. That solves the problem. And so is that what the government did? No, of course they didn't. They came up with something much more complicated, which is known as the resident nil rate band. So to demonstrate this, we've got a couple of examples I've put together, and we've got 2 scenarios in each example just to demonstrate the residence nil rate band. So the first scenario is we look at family home, and then the second scenario in each example, we look at what's the same scenario with shares. So in this example here, it's a very straightforward one, just really an individual has a share in a family home worth £300,000. Below the nil rate band, no inheritance tax. Same scenario with shares, £300,000 value, nil rate band 325,000, no inheritance tax to pay. It's worth noting as well that, of course, we haven't used up the full nil rate band. So if we have a surviving spouse or civil partner in that situation, they will be able to claim that additional £25,000. Okay, so example 2, this is the full residence nil rate band. So this is what the government intended. So we've got the family home and we've got the shares, and this just demonstrates how you basically save some money by having a family home and not having shares. So in this situation, the individual's leaving the family home worth £1 million. They get their £325,000, as I've mentioned, everyone gets, same with the shares actually. And then on the family home situation, they get an extra £175,000. So the amount chargeable to inheritance tax in this situation is £500,000 as opposed to £675,000 with the shares. And you'll see there that the inheritance tax saving that the residence nil rate band has created is a saving of £70,000. This is where it gets a little bit more complicated though. Basically, the residence nil rate band gets reduced, or tapered is the actual terminology, for £1 for every £2 over and above the threshold of £2 million. So again, we'll run an example here with a family home. This individual has left a family home behind them worth £2.1 million, and in the second scenario, they've left shares worth £2.1 million. As you'll see in example 3, the residence nil rate band has reduced from 175,000 to 125,000 because of that tapering. So although overall we're still left with an inheritance tax saving, it's not as much as the £70,000 in the first example, it's actually only a saving of £50,000. So the interaction of residence nil rate bands. So a married couple, as I've said, ultimately could benefit from £1 million of exemptions, which is what people are calling for. But as I've said, and certainly in our experience, families in London, etc., it's not very far before that residence nil rate band is actually fully eroded. But that's just a slide there to show you that potentially you could get £1 million off. A couple of other points I think I highlighted earlier. Unmarried couples, unfortunately, do not benefit from either the spouse exemption. So if one spouse transfers asset to another, that is exempt for inheritance tax, whether it's on life or in death. So it could be a very romantic reason to perhaps propose and get married. Also, the residence nil rate band and the normal nil rate band are not transferable to an unmarried partner. So again, there may be ways of certainly looking at the nil rate band, perhaps by using a will trust, residence nil rate band trust. But yeah, just a point to note there. Okay. Tax planning, obviously, another reason why we got into this area, because we were often drawn in, as Sunil mentioned, either after death, when we have a 2-year window to do a deed of variation, which effectively is a way of amending the will. We would rather do it in lifetime because it's much simpler. You know, it's what the settlor intended or the deceased intended. And it's much easier and much simpler and much less costly. So there's often looking at the use of trusts. Lifetime gifts is possibly one of the simplest ways of doing things. So just giving away an asset. I think most people are fairly familiar with the 7-year rule. You give an asset away, live 7 years, and you've done well there. You've actually dropped that asset out of your estate. Common misconception in that situation, though, and we still hear it many a time, friends down the pub or whoever it is, so-and-so told me that I can give my house away to my children and carry on living there. That is not true, sadly. Otherwise, I think everybody would be doing it. The key thing here is if you want to make a successful potentially exempt transfer as a term, you need to give the asset away, and you cannot benefit from it apart from certain exclusions, perhaps if you fall ill or something like that at a latter date. So again, it's crucial you make sure you get the advice so that if you do give something away, bear in mind you've now given it to the children. If it's a house, they could ultimately kick you out. But bear in mind you need to make sure you've done it properly so that it's had the intended effect. There are certain reliefs as well that can be looked at, making sure that you're making the most of your business property relief. I know a lot of people think that this could be altered at least in the forthcoming budget. But at the moment, certainly many assets that you use for business purposes fall outside of the estate because of the relief that's available. Charities as well, again, there are gifts to charities exempt, and certain other provisions that are allowed to basically help people give money to charity without having to pay tax on it. So just some of the key points as we've ran through all of this process. Working out whether there is any inheritance tax payable, that's crucial. Can we perhaps look at using a simplified tax return? That can save a lot of time and fees, and especially if you're doing it yourself. The IHT form itself, the simpler one, is as it suggests, a much simpler document. We can obviously assist with the executor's obligations. They do actually have to sign a statement. It used to be the oath to go and get the probate, and that's, as I say, the last step of the probate process. Collection of assets and, crucially, form filling. Yeah, one of the biggest headaches is the form filling exercise. There is no standard template. Certain departments of certain entities will ask for lots of forms to be filled. It's not a very exciting process. The situation is if there's ongoing trusts as well. Trusts, whilst they're very useful and can help in lifetime or on death in saving inheritance tax, you need to make sure that they're dealt with properly. So, just to conclude, as Ollie's explained, you can still make your will during lockdown, although that is a very interesting process if you want to go down the electronic route. If you don't make a will, you saw that slide from Sunil that was quite busy. There are some complicated rules in the legislation that deal with that situation, and we would strongly suggest that you make a will and regularly review it to make sure it's up to date and current and does what you intended to do. You might be able to get as much as £1 million if you're very lucky, but as I say, in our situation, in our experience rather, most people don't get that £1 million. Finally, you can still apply for probate during lockdown. I think we had the odd person. I know the courts were closed, but it was a bit slower, but you can still apply for probate during the lockdown. So that brings us on nicely to our Q&A session at the end. And Joe, I don't know if we've had any questions.
Yeah, we've got quite a few actually, Peter, so let me try and run through them with you. So one in, sorry, anonymous, so I can't attribute this question to anybody, but if a joint tenanted freeholder, I think in this case mother's son dies intestate, does the property need to be valued on the probate form or ignored, and would the daughter be entitled to half the value in that case?
Yeah, so do you want to answer that one, Sal, or should I?
Yeah, I'll answer that. It's fairly straightforward because it's joint tenants. Basically, the survivor will inherit the property. Basically, it's just transferred across, and it doesn't affect inheritance tax at all.
So I think the point there to mention, though, is that they will still need the valuation because the share, although it passes automatically, you still need to value that property because although it passes automatically, it's still value for inheritance tax. So you do need to make sure that that goes on the form. It goes in a different place, but yes, you still need to put it on. And if it's more than the 325, as an example, you will have inheritance tax to pay on it. So I hope that answers that one. That's the half share. Yeah.
And then we had a few questions posted by our guests before the webinar started. So the inheritance tax has to be paid before the grant of probate is issued, but what happens if you cannot pay the tax because the only assets in the estate require the grant of probate to be able to sell the asset to fund paying the tax? I think I get the question. Yeah.
Very common problem. Yeah, it's as I sort of explained about this £1 million, that was one of the drivers for getting the inheritance tax threshold increase. It does seem rather unfair, but yes, you've got 6 months to pay the inheritance tax. So even if you've just got a property worth, say, £2 million, you've got no other assets to pay, you're left with, you can pay the tax over 10 years and it's automatic, but ultimately you need to find that money from somewhere, and sadly in some cases you're going to have to pay for that by selling the family home. Very, very tragic situation, but again, you know, you've lost a loved one and then you also have to sell the family home to go and pay that, and obviously the revenue aren't always very sympathetic as well. To their credit, they are a little sympathetic, but they won't wait forever. And of course, there is interest if you don't pay it by the due date as well.
Okay. And another question here, can I as executor get access to the deceased person's bank account to pay funeral expenses and the tax?
Do you want to take that one, Ollie? Or Sunil?
Yes. Basically, you can get access to the money to pay for the funeral cost. You need to approach the bank or building society, and they will, as long as you provide the receipts for it, they'll happily reimburse you the cost.
The banks have actually got sorry, Sana.
In terms of other access, if you're going to pay the inheritance tax, you can actually pay that by actually completing the forms IHT 423, and the revenue will then confirm with the bank that this money is due, and they can pay that across.
Yes, it's one rule for the revenue and one rule for everybody else. So basically the revenue, everyone has to wait until you've got probate, but the revenue can physically go into somebody's bank account and take the money to pay themselves. So.
And if you're faced with expensive funeral costs which you lay out on behalf of a loved one or a friend, you can claim that back as an expense, an administrative expense from the deceased.
Okay.
Good point.
All right. Got a question here from Joseph. If IHT needs to be paid, can this be done, for example, in, I think it's AIM traded shares rather than in cash?
Yeah, well, no, sadly the revenue won't cash.
Yeah.
So in that situation, again, the probate process, it's a situation where you've got to realise cash to go and pay that. If there isn't enough money in there, you will have to realise some assets, or if you've got a particularly wealthy beneficiary that wants to perhaps inherit those assets, maybe they could go and pay the money themselves. That's another scenario.
And this is all a planning point, because often people use proceeds from life insurance to meet any immediate inheritance tax costs to free up the other assets, or indeed pension scheme money.
Yeah. Okay. I think this one's for you, Ollie. My will writer suggested I add them as one of my executors, as it will be easier because they're preparing the will and storing it. Do they have to do this?
No. There can be very good reasons for appointing a professional to act as executor or co-executor. For example, if a scenario which we've experienced where the beneficiary is a drug addict, he simply wouldn't be suitable for the role. In fact, it would be dangerous if he suddenly had control of those funds. Professional executors in those scenarios are good. On the other hand, if you appoint a professional executor, you give them equal decision-making power alongside the family, and sometimes that's not also suitable. If you're lucky enough to have a family that gets on, or you're in the minority, then it's possible that the family members themselves can take that role and take advice from whoever they want. So you don't have to, no.
Okay. And
I think it's probably worth mentioning actually on that point as well that there was a very, I don't know if it was a misconception, but certainly one of the reasons again why we got into probate, and as I think you're hearing, it's doing balance sheets, tax returns. 95% of it is all kind of things that we do anyway. But a lot of the time people get the will, and if there are professional named solicitors in there as a typical example, the family at a time of grief will just pick up the phone and assume that they need to go to those people in the will to go and carry out the probate, which isn't the case. And again, one of the reasons why we got into doing probate services, because again, a lot of that information we already have on our files. So.
Okay. Another one related to the nil rate band here. Is the residence nil rate band available to my beneficiaries if I sold my home to move into a residential home?
Do you want to take that one?
Yes, it's actually still available. It's called downsizing allowance. So the government do recognize that individuals will in their lifetime move homes, especially in their later life when they may have to go to a nursing home. So they would actually either sell the property just to finance their nursing costs, and they do recognize that and they do allow for that.
Okay.
Again, I'll just add on that the rules are far from straightforward and you need to meet certain criteria, so take advice.
Another question come in here. Is the £2 million threshold for residence nil rate band per taxpayer or per couple?
I'll take that. It's basically, it applies to a couple. So basically, on first death, it is best to take advice and try and reduce their estate. So by the second death, you're still within the £2 million limit.
Okay. And we've got time for a couple more. Question here from Philip. I've given a family members 325,000, I'm assuming already. Assuming I survive for another 7 years, can I leave another 325,000 in my will and still avoid IHT? And do I have to notify HMRC of the money already given?
Okay, that's a good question. I'll take that one. So yeah, lots of people, whether you do it as a, without being too technical, whether you do it as a chargeable lifetime transfer, whether you do it as a potential exempt transfer, the difference there is if I've got 325,000 in cash, I'll give that to a family member and then wait 7 years and do it again. Recycling is sometimes called. You could do the same thing with a trust. You could put 325 into a trust. That's technically chargeable on day one, but if you do it up to 325,000, it's not taxable at that point. The point is inheritance tax always looks back 7 years. So yeah, under current legislation, it's possible to do a 325 per person every 7 years. However, the government did look at this when they were looking at trusts, and they brought in some anti-avoidance legislation to deal with something called pilot trusts. There was a suggestion that recycling would also be stopped, but at the moment you can still do this every 7 years.
Mm-hmm. And we've got one final question in the last minute. I want to appoint different people to look after my business and personal finances, and does the LPA allow for this? Yes, that's one for you, Ollie.
Yes, actually underused, you could make a lasting power of attorney, what's called a business lasting power of attorney, and appoint people specifically to to sign on your behalf and step into your shoes in relation to your business. And they can be separate from the people who can access, you can appoint one for personal finances. And that can be more suitable where you have someone who's a business owner and they appoint their partner, their business partner, to step into their shoes in relation to business decisions, bank account signatures and so on. And they may not be the same people that you want to step into your shoes for your personal finances. And so yes, you can do that. You can have, it's 3 lasting powers of attorney, one for health, one for personal finance, and one for your business. And the attorneys could be different in all 3 or mix and match as suitable.
Okay. Well, it leaves me at this point at 10:43, just to close off this webinar. I want to thank everybody for attending. Thank you to Peter, Ollie and Sunil for your contribution today. We will make a recorded copy of this webinar available on the Grunberg Co website later on today, and all of those that have attended, you will get an email as well with the on-demand version of the webinar if you want to rewatch or go over any of the questions that have been asked. So thank you very much, and we look forward to our next one.
Thanks very much.
Thank you.
Thank you.